Good afternoon, everybody, and welcome to this edition of our weekly market analysis session for Monday, 28 November. My name is Carl Capolingua. I'm the market analyst over here at Think Markets Australia, and it's a pleasure to be with you as we delve into all the key market moving events for last week and look to the week ahead. Let us kick off with crypto. Now, just a reminder, take a Saturday to Saturday snapshot here. Sunday was roughly flat. Monday is down, however, so 2 to 3% falls pretty much across the board there. But in terms of thematics, Binance Coin, the clear winner last week, up nearly 15%, almost the last man standing now with the implosion of FTX. So that is seen to be a major beneficiary of that fallout. Also caught in the fallout of FTX was Solana, and you can see there 53% down on the month, 93% down year on year, so nothing more than a bounce back, I'd suggest. Dogecoin did well. I don't know, maybe an Elon Musk at Twitter sort of thing. That's what got going in the first place. Ripple's done pretty well, but so have some of those other, OG original altcoins. So I know Ripple doing well, but Litecoin doing quite well. Monero doing pretty well. Not on screen, but go check those out as well. Litecoin probably the pick of the bunch in terms of the technicals. Have a look at the fear and greed index, not really factoring in today's declines, but for what it's worth, 28, which is up from last week's 21. We are still very far from being bullish though. And we talked about thematics before, and again, it's all about FTX and what could go next. What's going to be caught up in this contagion? Well, fortunately, nothing really bad happened last week, and that helped us not break 15,563. The risk is, of course, something else does go down. I can't really see a lot of positivity on this chart. By that I mean I can't see the demand coming in to overwhelm the supply that's so clearly in the system. And without that demand, and with supply really quite rock solid, it's hard to see much upside. If there is going to be upside, look, we need to print. I mean, you can see this huge resistance zone here, huge potential supply zone, starting at 17,585 and going up to 8,608. Printing anything above that would be incredibly positive compared to where we are right now. Having said that, though, not out of the woods, because if we can eclipse this zone, we've still got a huge amount of supply in here. I don't think that's going to happen. I think we're more likely, if anything, to come down and crack 15,563 and then 13,870 and potentially even 12,479 are on the agenda. So sorry for the crypto lovers out there. I can't see a lot of light at the end of the tunnel just yet. Ethereum has probably fared a bit better than Bitcoin. That's somewhat encouraging, but the long-term trends are still very much set to the downside. In fact, the short-term trend is impeding upward price action here. Looking at sort of a 1250, really probably even 1300 to say that this has got any chance to go up and test that longer-term downtrend zone, which is kicking in just above 1500 there. More likely to move back down to 1071 and then breaking that. It's not looking good, probably 880. Okay, let's bring it back to stocks now. And generally, a stronger performance from stocks across the board. We can see plenty of green on the screen there, with the exception of the Hang Seng down 2.3%. But otherwise, stocks were up. Volatility down. You can see the VIX index here moving back towards its lows for 2022. The other key theme here, I think, is looking at the Dow Jones there, up 2.4%, significantly outperforming the NASDAQ, which was up 0.7%. And this is really that interplay between value and growth. The Dow Jones representing that value trade, so really defensive trade. Look, I'm nervous about what's going on in the world, but I kind of have to invest in stocks right now because I've got too much cash. So I'm going to target those big blue chips in the Dow Jones, compared to, well, I am nervous, and therefore I'm less likely to put my money into those high growth, high PE, or even pre-earnings stocks that exist in the NASDAQ. So that is a really interesting thing that continues to play out. Otherwise, as I said, stocks pretty much higher across the board. Have a look at the S&P 500 now. Just quickly, from a purely technical perspective, it is looking very strong, at least in the short term. High peaks, high troughs. We are seeing that this 39.12 point of supply now acting as a point of demand. Short-term trend ribbon is up, and we're having some nice candles last week. I know it was an abbreviated week with the Thanksgiving holiday, but otherwise some pretty nice candles into a zone which should represent dynamic supply. We should be expecting supply in and around this long-term trend zone. That's what it does really well. You can see over here we eventually got that supply. It was a bit of a lagged effect through that bear market rally, and certainly the price action getting caught up in the ribbon here. And if you zoom out, and I encourage you to do that, you'll see how on the way up, the dynamic ribbon acted as support. So we expect this to be supply. We're not seeing a lot of it now, and that does, I think, facilitate a continued rally potentially into 41.20 or 42.03. Maybe that's a stretch for this week. Now, I don't know what's going to happen next. Of course, I can't see tonight's candle in the US. Apologies for that. But what I can see is, demand in control of the price action at this point in time. So I can't see anything too sinister in that chart to suggest we would go down. Hey, if we do, 39.12 is that key level again, and failing that, really, there's plenty of demand in here, even if we do fail that, to be fair. So let's say onwards and upwards for the S&P 500. The NASDAQ doesn't look anywhere near as good. It is still short-term uptrend, high peaks, high troughs, let's say. I mean, there's maybe a little bit of an even peaks and troughs in here, but candles looking half decent. And we are being supported by that short term, let's call it an uptrend zone, because the 21 has printed over the 34. It hasn't been in place long enough for my ribbon to print green yet, but let's call it uptrend. Look, resistance to the upside, 11.5 to 11.6, coming in from this peak over here. And then above that, we are going to start to interact with that long-term downtrend zone kicking in, I'm going to say around about 11.8. We would need to see how the candles print in there. Bunch of white candles, nothing to worry about. We're going to get dragged higher with those value stocks. Bunch of black candles, well, that would really give me cause for concern, because it would indicate, I believe, the beginning of a continuation in line with that long-term downtrend. To the downside, just looking for key demand levels there, 10.745. Look, I'm going to say as long as we're trading above that, we're probably fine. Just comparing and contrasting the Dow Jones Industrial Average, so looking at that chart and that chart and that chart and that chart, and you can see just how much better value is compared to growth, and that isn't always a good thing for stocks. I know, hey, anytime stocks are going, or any stocks are going up, that's great for the bulls, but typically in terms of the sustainability of that upside move, you don't want to see value necessarily beating growth, because growth is high risk. You want to see risk-taking activity. Talking about risk-taking activity, certainly some more of that occurring here on the Hang Seng Mainland Properties Index, continuing to bounce back on a raft of packages and support for the property sector coming from Beijing, and then Beijing strong-arming China's biggest banks to continue to extend credit at favorable terms, and also to extend payment deadlines for many of those big property companies. I think a couple of important points here. Those lines of credit that are being extended from those big Chinese banks are targeting stronger companies. They're not targeting weaker companies, I mean, for obvious reasons. The order of magnitude of the package, there was about 62, if I'm not mistaken, billion in terms of loan extensions. And then we had another 30 billion of these big bank facilities being made available. Still very, very small compared to the total size of the Chinese property market, which is in the trillions, and the total size of the outstanding amount of debt, which is in the hundreds of billions for these property companies. It's not just a matter of, I don't think you can fix the situation by simply extending more credit to a sector that is ridiculously indebted in the first place and is struggling to repay those debts. We've had a number of firms come out and say, we are struggling to repay these debts. We're probably going to miss some of our deadlines. So giving them more credit is probably unhelpful. Extending that credit might be helpful if you can fix the demand side of the equation. And I think that's the big problem here, because most of the information I'm seeing is that prices are falling, or they have fallen modestly, to be fair, at the start, but the expectations are for somewhere between 20 and 30% declines in some areas over the next 12 months. And that demand is severely constricted because of the financial hardships that people in China are experiencing because of their zero COVID policy. And we did hear a couple of weeks ago about this quote unquote relaxation of 20 various rules and regulations to do with their COVID policy. They said they would take a more targeted approach otherwise, but actions speak louder than words in China, as has always been the case. And there's nothing that has occurred since that original announcement, which sparked a huge rally in Chinese and Hong Kong shares, to show that we are anywhere near zero COVID. So we look at a chart like iron ore, and I'm going to treat this fledgling rally, which looks promising from a technical perspective, with a modicum of skepticism. But hey, purely on the technicals, I think there's a little bit more upside. Where to? Well, you can see that long-term downtrend zone and a couple of other static resistance areas kicking in sort of between 105 and 107. It'll be interesting to see what candles we print there. Those black candles with the long upper shadows would indicate supply. Hey, if we print a bunch of white candles, don't worry about me. We're probably going higher. Look, I actually forgot to adjust that. So I will take the data providers I use from there. I normally have to go and correct them. Let's treat those two numbers with a pinch of salt, but we can see we're probably up a little bit on the week there for iron ore. The rest of the data, I'm sure, is rock solid, but it comes from the London Metals Exchange. And we can see those other industrial metals actually weaker over the course of last week. So aluminium, significant fall, 2.65%. Dr. Copper, that key industrial commodity, and we call it Dr. Copper because it's a great indicator of the health of the global economy. Down 1%, lead down 1%. Nickel actually up a little bit there. And tin and zinc also down. Precious metals up, but that's more of a US dollar weakness thing. We'll talk about that in a sec. Coke and coal, obviously you mix this up with your iron ore to get your stainless steel. We can see how that is underperforming. So we've seen that big bounce in the property index there in China, but no response here from the coking coal price. That's interesting, not moving in line with iron ore as it typically does. And we can see, again, despite that better news coming out of China, significant weakness, I'm going to say, in copper over the last couple of weeks. And, last week, whilst it did try and rally on some of that broader, risk on sentiment in equities and that property market rally in China, it really didn't look very healthy at all by the end of the week, did it? So I'm going to say that long-term downtrend is very much in place, and that doesn't bode so well for global growth going forward. Nickel did get a pop. There were some specific industry-related supply factors there. It did pull back from that, had a little bit of bounce this week, but you can see Friday just pulling back again. Probably that short-term uptrend is starting to deteriorate. That's what I'm going to say, probably. Gold looks good on the other hand. Again, this is more about US dollar weakness. I'll show you that chart in a sec, but I think the US dollar will get weaker, which I think facilitates more strength in gold. It certainly appears to be challenging that long-term downtrend zone and maybe even changing that trend as well. Short-term trend is up. Candles look pretty solid because I can see some great big white candles to the upside and a fairly limited response to the downside, indicating, there's a bit of supply out there, but demand appears to have it covered. Having a look at the energy side of things, we can see some weakness there in crude oil. OPEC coming out saying they may actually increase production by 500,000 barrels per day. And I think the long-term trend there is now set to the downside. I think for all intents and purposes, we can say that long-term uptrend that's been in place for many months since that COVID low, I think this is a downtrend now, and I think we should expect lower prices for oil going forward. That could help stocks too, because it helps us on the inflation side. But a close below 76.25, I think, would see us head into 66.12 and maybe even 62.43. Also, not a great indication for global growth going forward. So West Texas crude down 4.4% and Brent down 4.2%. Natural gas, we'll see that chart in a second, that was up 8%. So we're seeing a bit of a dichotomy here between the growth trade and the keep warm trade. Aussie dollar, euro, sterling, and the yen all higher as the US dollar pulled back. And we did see bond yields decline over the course of the week, I'm going to say, on a deteriorating global growth outlook. Natural gas, I said, certainly the contract in New York up about 8%. Is this the start of this fabled keep warm trade that we never got? We were all expecting, after Russia invaded Ukraine with supplies very tight, that if we had a really, really cold winter in the Northern Hemisphere, then this would go berserk. We got the opposite. We got unseasonably warmer weather. We had stockpiles growing, and you saw that pull back from 10.03 into 4.75. But it's, I've said this the last few weeks, it's a nice recovery from 4.75. And I think if we can sort of sustain and close above that 7.50, I think there's more in this one. So this is my sort of keep an eye out trade for this week. Not yet backed up convincingly with the natural gas contract in Europe, but there is, the shapings there of an inverted head and shoulders pattern. So watch this space is what I'm going to say there. Newcastle coal rallied during the week, but I do think the tide is turning here on this long-term trend. let's see how it goes from here. If we can push back down through sort of 330, 320, I think it's confirming that this long-term trend is turning. Hey, if we get above, say, 375, 380, then perhaps I'm wrong and this long-term trend can sustain. What I can say is if I'm right about natural gas and there's some more upside there, then that would be helpful to keep thermal coal prices up. Keep an eye out. Having a look at uranium, look, there is a correlation there, I guess, between that keep warm trade. So if natural gas gets going, maybe there's some upside here, but otherwise it's looking pretty flat. I said we'll look at the US dollar weakness in the chart here, and you can see that it's such a convincing breakdown into the long-term uptrend zone, which should offer dynamic support. It did to a certain extent, but when you do break back down again and pressure the bottom end of that zone, that's usually a pretty good sign the trend is changing. Short-term trend well established to the downside. I'd say if we're closing sort of 105 or less, then that uptrend is over. Ramifications of that, it makes things more expensive in the US. We talked about maybe crude oil helping, but a falling US dollar, increases import prices and therefore doesn't help inflation in the US. That could be a negative for stocks. Otherwise, it can help commodity prices, which are largely priced in US dollars. That relationship only goes to a certain extent as well, because those commodity prices are going to move ultimately on global growth outlook. It can help a currency like the Australian dollar, which is looking pretty solid here. Looks like gold. So whatever I said for gold is ditto on the AUDUSD. I'd say close above 68. And it's going to surprise, I think, a bunch of traders who are caught on the short side here. And we could see an overshoot into maybe 71.36. But saying I wouldn't want to be short this one just now. We are in a pretty key area of supply, though. And I'm hedging my bets a little bit here. But it's candle dependent. Bunch of black candles, upper shadows. Then you can start to look to enter shorts in this zone. But until you see those, I think the path of least resistance in the short term at least is up. Bonds looking like Aussie bond yields have turned. RBA taking a little bit more of a dovish stance, and we're getting weaker data on the Australian economy. Pretty similar here for the US bonds. We're looking at the 10-year note here. For all intents and purposes, I feel this trend, at least in the short term, certainly has broken, as in I think there's more downside here. Long-term trend, it's too early to say, but we could see yields coming back into 3.4%. The problem with that is, next slide, you've got the short-term yields stuck up there, and they have to be stuck up there because they're reflecting what the Federal Reserve is doing, around 4.5%, and we're still thinking interest rates in the US are going to top out at least 4.5%, so another, at least 75 basis points to come. If it's more like a 1% to come, then we're going to get close to 5% on that. So those short-term yields have to stay high, and we're seeing those longer-term yields peel off because of the deteriorating growth outlook going forward. So the expectation is at some stage, these short-term yields will have to come down because the Fed's going to start cutting rates to try and stimulate the economy. How about that? So look, we're at a very, very interesting juncture. You count on one hand the number of times this sort of scenario happens over 100 years, and we're dealing with it right now, and you're dealing with it as well as an investor. The other little thing here is, I'll just note on the 10 years, what we're seeing here is the inverse relationship between bond yields and prices. So whilst yields are coming down, it means prices are going up. So bonds are rallying, it means money is going into bonds, and bonds are a great competitor for stocks. For most of 2022, we saw stocks and bonds move in the same direction. So bonds down, stocks down. But now we could see with this stock market rally sort of getting way ahead of the bond market rally, if there is a bit of a movement, this increasing conservatism, we talked about the value trade already, this increasing conservatism could push more money from stocks back into bonds. Hey, I know I'm giving you lots of different things going on right now, but as I said, maybe 5 times in a century, you've got to deal with these things. Looking at the yield curve there, we can see for the week, that's the orange line, it was slightly higher, pretty much across the board there than a week ago, and steeper as well in terms of its inversion. And anytime you've got an inversion, it's generally pretty bearish or a strong indicator of a recession. Having a look at some of the data out during the week, we had the G4 PMIs coming out. So that's the US, Eurozone, Japan, and UK off the top of my head. And one thing that we've been saying quite a lot lately, wherever you are, is that employment is very strong. The labour market's very strong. Household savings are very much intact. and this is stimulating demand, I guess, in the economy and preventing the hard landing. Well, for the first time in a long time, 18 months really since the pandemic, we can see now these employment gauges starting to turn down, and these are very much advanced estimates of what you're going to see. This is industry estimates, industry data, which will then feed into the official government data for employment down the track, of which we're going to get a reading on Friday in the US. So note the downturn here in the G4, and this is the US PMI data here, which fell sharply. I'm going to say the composite index was 46.3, down from 48.2 in October. Anything below 50 is a contraction. Specifically, because we measure services and manufacturing, services down to 46.1 from 47.8, and that was below the forecast of 48. And then your manufacturing down to 47.6, which fell into contraction territory because that was 50.4 and well below the expectation of 50s there. So firms struggling with rising input costs, higher borrowing costs as well, and slowing demand. Now, what is the Federal Reserve doing in response? Well, they seem to be at this point less focused on sustaining that demand in the economy and more focused on killing it, because they know if they can't kill that demand, they're going to kill the inflation. That's interesting in itself. Now, the market has had a huge bounce recently, mainly due to that better than expected CPI data, that is the October data, which spurred this rally, and then it was reinforced with the Fed providing a more, I wouldn't even call it dovish, but that's the way the market interpreted it, outlook on interest rate hikes. So we can see here that substantial majority agreed that likely soon would be appropriate to slow the pace of interest rate hikes. Now they're going at 75 basis points, so slowing it could be 50, which is still jacking up interest rates. The Fed is expecting inflation to be at 4.6% core, which is more than double the 2% they're targeting. They are, again, going with this narrative that household sector balance sheets are very strong and the labour market is very tight. We saw in the last slide some weakening on that point. But the crux of it is that we are still going to get increases. It's not, they haven't stopped increasing rates. They haven't started cutting rates. We're still getting increases to fight this inflation. So markets don't know, potentially with the rose-coloured glasses on, only seeing the positives and not aware of some of the risks out there. Like I said, plenty of cash out there. It keeps piling into those fund managers' coffers, and they've got to put it at work in the market, for better or worse, regardless of where they think prices are going to be in 12 months' time. So what I'm telling you here, that there are many passive funds out there, okay, many index funds that will put money into the market for no other reason but money is coming in the door. So you might have people working at these businesses that totally believe that stocks will be down 30% in 6 months, but they will continue to invest for no other reason but they are mandated to do so. And that can stimulate when the market is very thin on the supply side, significant rallies. Hey, it's November, late November, we're coming to December, Santa Claus is a calling. Having a look at some more bearish data here, and hey, I'm not making this stuff up, and I'm just kind of reading the news here, so don't kill the message. I'm not trying to paint a bearish picture of anything. I'm just telling you that the PMIs for Australia are in contraction. We're at 47.7 on the composite, so services down to 47.2. I should say we're in contraction on manufacturing because we're still at 51.5 there, but that is a 29-month low. The most disturbing thing for me in this data was that new orders are starting to dry up, and so is the level of work outstanding. So when you don't have new orders, and when you've got through all the work that was banking up, you're going to have less need for employment. Okay. Now, employment was still up in the survey, and the rationale there from businesses is they are restocking, much like you would restock inventory after you've had a big run. You've had a big run effectively on your employment, and you're restocking your labor. You're trying to get access to the skills to get you through to the next stage, whatever that might be. Overall optimism was down, however, at a 31-month low, and prices are up, so that's not good for the inflation side of things. The blue line is the manufacturing, and the green line is the services, and they are not heading in the right direction. And as we talked about, new orders getting weaker, you would expect that to continue. Having said all of these things, and again, I don't want to be the bear. Have a look at how well the Australian stock market did last week and how well it's done since the beginning of October when we were at 6,400. And let's do the maths now. We got, we're 850 points higher, okay? And we've paid a bunch of dividends in that period. So if you look at on an accumulation basis, if we were able to draw the chart with dividends added back in, we're up around here. We actually got within 3% at one stage last week of our all-time high. How about that? Considering everything that's going on, and green across the screen. Not a single sector was down last week. It's a unanimous vote of confidence in Australian shares, and the only thing that did come down was volatility. We are in a bit of a supply zone, and that's my view, 72.89, 72.55. I think we're going to see a little bit of supply here, and you can see it actually coming in today's candle already. I don't think it's going to be so sinister to warrant the beginning of a new downtrend or anything, like the beginning of the bear market or resumption of the bear market, because this is just so strong. If anything, you've got demand all the way down 71.02 into probably 70.12. Pullback's probably shallow, if anything, and we're going to go up and test those higher levels. And I have said last week, I did in the media, I was on Ausbiz, and I said to David Koch on the call on Wednesday, I said, hey Koshy, if this thing here, the XJO 200 gets to 7,600, I reckon I'm going to go all to cash. Not I reckon I will go all to cash, and I'll do it live on screen when it occurs. That's how much I think potentially prices have gotten ahead of some of the risks that are out there. And everything I'm concerned about means nothing here. So ignore all that, because the market breadth improved. It improved during the week, and it is, to be fair, it's getting closer to what you would call a bull market. It shouldn't be any surprise with those stock prices on that last chart doing so well. And trends are improving. We've got almost unanimous there short-term uptrends, and close to 50-50 now on those long-term trends. It's a recording. You go back, press pause, and have a close look if you need to. And I'm going to do that on this one because I want to finish this one in a timely fashion. But let us just say we're getting pretty close to fair value here. Prices are going up. Okay, you can see where we were a month ago, below 13 on the 1 year forward PE. Now we're at 14.2. Fair value is around about 15, expensive 20, and 10 is cheap. So prices are going up, but earnings expectations aren't going up to match them, and therefore we're getting PE expansion. Cheap sectors, well, we always look at energy and we say materials as well, but they are cycling big bumps in their earnings, so disregard those. Cheap sectors. Discretionary, not so much. I wouldn't say that was cheap. Financials still looking relatively cheap here, okay, but way up from where they were a month ago. Healthcare looks expensive to me. Technology actually getting cheap. How about that? I haven't said that for a while, but technology is cheap. Compare that to where it peaked out at 77. We're now at 26.5, so maybe some value in those tech shares. Property looking cheap. Staples, not on the right side of fair value. Let's just say that. Telecoms, I would say, looking crazy expensive based upon those metrics. And utilities, well, probably not on the right side there of fair value. Okay, coming up this week, RBA Governor Philip Lowe speaking today. In fact, that one's happened. I haven't caught what he had to say, so I have to go check that one out. Maybe you did. And speaking on Friday, if you wanted to skip this one and catch that one. Otherwise, building approvals, retail sales, private sector credit. Look, nothing too market moving there, but plenty of market moving stuff coming out. OS, particularly in the US, Conference Board Consumer Confidence Survey coming out Wednesday. We do have Christine Lagarde speaking there for the European side of the equation, as we also have CPI flash estimates there on Wednesday. But it's the US data I'm more worried about. We've got obviously ADP non-farm employment change on Wednesday, preliminary GDP, JOLTS, job openings, Jerome Powell speaking. How about that? And then we're going to get on Friday the core PC index, the Fed's preferred measure of inflation. We're looking for the core to go up 0.3%, which is moderating from the previous 0.5%. Personal income, personal spending, ISM manufacturing, PMI. Lagarde speaking again, and then the big one on Friday, the non-farm payroll. So an absolute chocker week. Chocker week for me as well. Come and join me tomorrow for Ask the Experts. Bring your portfolio along. I'll give you a quick technical and fundamental reader on your stocks. Head to www.thinkmarkets.com.au webinars for more information. If you are not a client of Think Markets, you should be. We are the good guys in the Australian broking scene. One of the reasons for that is you can trade good old-fashioned shares for your self-managed super fund, over 3,100 and ETFs at $8 at flat rate, CHESS sponsored. There might be a cheaper rate out there here or there, but they are not CHESS sponsored. I challenge you to find a cheaper rate that is. And you can also trade your CFDs all within your same client portal, over 4,100 of those. You can trade pretty much any of those big major markets around the world, shares in the US, the UK, Germany, Hong Kong, Japan. If you can think of it, I'm sure we've got CFDs that you can trade there. Indices, so trade something like the NASDAQ or the Dow Jones. Commodities, maybe you've got a view on oil. I talked about potentially shorting that, or a pairs trade where you go long natural gas and short oil. That could be very interesting. Cryptocurrencies and shares as well. We are commission free on our share trades, including Aussie shares. Award-winning broker. We haven't just been around for 5 minutes. We've been around for many, many years. Easy to use multi-asset platform. We are an award winner and we are regulated all over the world. Over here in Australia, regulated by the Australian Securities and Investment Commission, and we have a Melbourne-based office. World-class trading apps on your mobile or desktop, and a dedicated account manager who you get to know. They'll look after you through your journey. None of those silly chatbots. Head to www.thinkmarkets.com/au for details. If you're watching me on the YouTube, make sure you hit the subscribe button to stay notified of my weekly updates. Generally, I'm putting videos up on a regular basis, and hit the like button, please, to let me know you like what I'm doing so I'll continue to do more of it. Apart from that, it has been a pleasure chatting with you today. All the best for your investing. Until we catch up again. Bye-bye for now.